in terms of the type of material that we cover in it. And it's a pretty lengthy chapter, but students tend to do pretty well on this chapter on the assignments. It's called Cash and Internal Control. And when we talk about internal control, it's always defined this way. It's the plan and the measures that are designed to do 4 things. First of all, safeguard assets. The assets could be cash, or it could be inventory, or it could even be a company's buildings or equipment or vehicles or something like that. Second, it's to encourage employees to follow company policies. Third, to promote operational efficiency. And fourth, to ensure accurate, reliable accounting records. We talked a little bit in chapter 1 about the Sarbanes-Oxley Act, SOX, that was passed by Congress in 2002. There's more information about SOX that is covered in this chapter. So we'll run through a few of the specific provisions of the SOX Act here. First of all, public companies must issue an internal control report each year, which is a report by management describing their responsibility for and the adequacy of internal controls over financial reporting. And then the auditors, the CPA firm, must evaluate the internal controls as well. And so now, ever since 2002, the CPA firm actually issues 2 opinion letters at the same time each year. The first opinion letter is the traditional one where they state whether the financial statements are prepared in accordance with GAAP. And then the second opinion letter states whether they agree with management's assertion that internal controls are in place at the company and operating effectively. Then the second part of SOX that we talked about already in chapter 1 is that it established the Public Company Accounting Oversight Board, the PCAOB, which licenses CPA firms to be able to conduct audits of public companies. And if the CPA firms don't do an adequate job of performing the audits of public companies, then the PCAOB can take away their right to conduct those audits, or can fine them or take other types of action against the CPA firms that are doing the audits. Third, accounting firms, CPA firms, are not allowed to audit a public company and also provide, the slide says, certain consulting services for the same client. In reality, if you conduct the audit for a public company, there's only one other service that you can provide to that client, which is that you can prepare their tax returns. The reason that you can't provide other services like consulting services is that that creates a conflict of interest. And it came up in the case of Enron, because with Enron, the CPA firm was Arthur Andersen, and they were making so much money from providing consulting services to Enron that they felt that they could not give Enron an unfavorable opinion on their audit, because if the company went under, they would lose all of that revenue that they had from their consulting services. So they were kind of stuck. They had to say that Enron's financials were okay, even if they weren't. So to get rid of that conflict of interest, really, now you can't do anything other than conduct the audit, and if you wish, also prepare the tax returns for the client company. And fourth, there are criminal penalties that are provided for, especially for the CEO and the CFO of the company. So there can be a criminal penalty of up to 25 years in prison for securities fraud and 20 years for cases where an executive makes a false sworn statement. Okay, next we're going to talk about the components of internal control. There are 5 components of internal control. These are always stated the same way, and we'll cover what we mean by each of these. The one that we're going to save until last is control procedures. We're going to talk about control procedures the most because in financial accounting, that's the one that you run into the most on a day-to-day basis. So first, risk assessment. This is where we consider what could go wrong and how to protect against it. So for example, we make sure that we have insurance policies covering the company's assets. This was a problem. The first job I had in working for a business after business school, one of our manufacturing plants was in Los Angeles, and there was a big earthquake in Los Angeles, and our plant was destroyed in the earthquake, and we didn't have any insurance on the factory. So it was a total loss, and we ended up shutting down that division of our company. So after that happened, then we were a lot more careful about making sure we had insurance policies on all of our assets. Most companies, or at least larger companies, have a policy that all of their executives cannot fly together on the same airplane. Because if the airplane crashes, you don't want to lose all of your top executives at the same time. You want there to be somebody left who can run the company afterwards. Okay, the information system, when you think of this, you think mostly of accounting software, but it also applies to all kinds of software that is used to manage a company. These days, larger companies have what we call ERP software, Enterprise Resource Planning software. It's made by companies like Oracle and SAP. St. Petersburg College actually has Oracle software to run its operations. And so with software, you want to make sure that there's no unauthorized access to the software. You do that, of course, partly by having usernames and passwords. In some cases, you also have electronic controls where people can't get into rooms where you have data processing taking place unless they have a security code to get in or a badge that they swipe or something like that. Then also when it comes to approving transactions in accounting software, only people at a certain level within the organization would have adequate authority to approve certain transactions. So, for example, if a transaction involves $10,000 or more, it may be that only someone who is a director or higher within the organization would be able to approve that transaction in the software. Those are some kind of typical controls that you would have with software. Okay, next, monitoring of controls. This usually applies to auditors. And we've talked already about external auditors. External auditors are those that work for a CPA firm, and they conduct the annual financial audit. They also do auditing, as I was suggesting earlier, of the company's internal controls. But you also have another type of auditor that we call internal auditors. Internal auditors are actually employees of the company, and they work in what we call an internal audit department. And some of the audits that they conduct are not necessarily financial type audits. They could be all different kinds of audits, such as checking for company policy adherence and making sure that nothing that is illegal is being done by the company's employees. So, for example, when I worked at a manufacturing company, an example of an audit that our internal auditors were doing was that they were auditing our shipping department, and they were making sure that the employees who worked in the shipping department were using the shipping or the freight carriers that had the lowest rates to ship our products, and making sure that nobody was receiving kickbacks for sending our business to certain freight carriers. So making sure that everything we were doing was as efficient as possible, and that it met our company policies, and that nothing about it was being done illegally. The control environment, there's a term that we often use for this. It's called the tone at the top of the business. You want your top executives in the company, including the CEO, to set an example for the other employees. You want them to behave honorably and ethically, and by doing so, you want them to demonstrate the importance of internal control. If your top, yes?
I don't know if they want to pick up their bags, but you got ants crawling around the floor.
Right.
I forgot about
Thank you.
If the top executives of the company are seen doing things that are unethical or not fully in compliance with the law, then the rank and file employees of the company are going to feel that the company doesn't really value ethics, and therefore we don't have to act ethically either. If we, steal a few dollars here or there, there's nothing really wrong with that. We're following the same type of behavior as the top executives in the company follow. So that's why it's important for the top executives to really set a good example for everybody else. Okay, now we get to control procedures. This is everything that's designed to ensure that goals are achieved. And there's a whole list of control procedures that we want to consider. We want to have competent, reliable, and ethical personnel. And that means having appropriate hiring procedures. We have assignment of responsibilities. That means that every employee has a job description and they know who it is that they report to. A very important control procedure is that we have separation of duties. We always separate operations from the accounting for the operations. And we separate the custody of assets from the accounting for transactions. So typically there are two financial type departments within a larger company. One is the accounting department, which is headed up by an officer called the controller. The other is the treasury department, headed up by a treasurer, or sometimes they call that department the corporate finance department, but it's headed up by a treasurer. So the treasurer is responsible for the custody of assets like cash, insurance policy, bank accounts, etc. And the controller in the accounting department is responsible for the accounting for those assets. You conduct audits. You have adequate documentation of transactions. You use electronic devices. There's certain controls that are relevant specifically to e-commerce. So for example, you have firewalls, you have data encryption, passwords, digital signatures. You have fireproof vaults that are used for important documents such as your board of directors minutes, your also insurance policies, securities, etc. You use alarms and security cameras. You have bonding of employees. A bond is a special type of insurance policy, and usually you bond any employee who's involved in handling cash. And if the employee ends up stealing cash from your company, then the bonding company reimburses you for the loss of the cash. There are two reasons why you bond employees. First of all, the bonding company will do a thorough background check on the employee before they agree to issue a bond on them. So if they've stolen money from somewhere that they didn't work before, the bonding company's gonna find that out and point it out and not agree to bond them. And second, it's been shown that if an employee knows that they've been bonded, they feel like there's somebody looking over their shoulder, and they're less likely to steal money in the first place. So you're not going to have those kinds of issues arising then. Okay, you have mandatory vacations. So if your employees get 2 weeks of vacation time per year, you require them to take it. You don't allow them to roll it over to the next year. You don't allow them to take cash in lieu of vacation time, etc. In terms of internal control, can somebody guess why it would be that we require an employee to take all of their vacation time each year? Yes.
Because it will offset the accounting balance. So like sometimes you get paid time off, and that's one of the reasons. Or sick leave. So some of that stuff can't roll over. So like when I was in the Army, I could only roll over no more than per year. I couldn't roll over no more than 60 days.
Okay.
And anything over 60 days would automatically be taken away.
Yeah. Okay. But there's more of an underlying reason though that I have in mind. Yes.
Would it affect the cost of goods sold if you're a product company?
I don't know. It's not what I was thinking of. The main reason in terms of internal control is that we want some other employee to do your job duties while you're away on vacation. And then they can find out if something's amiss, and they can point it out to the management. If an employee doesn't want to take their vacation, that's an indication that there's something that they may be trying to cover up in their job. So you force them to take their vacation. And then job rotation, that's for exactly the same reason. Usually, and in practice, you may not see this happening all the time, but ideally, you don't want somebody to serve in the same job for more than about 2 years, because you'd like somebody else to move into that job and then see if they can point out anything that was done inappropriately by the person who previously held that job, and they can point that out to management as well. Okay. Okay, here's some sample questions that are typical of the kind of multiple choice problems that you could get in my lab for chapter 7. So here they give us a list of some typical control procedures, and they give us a fact situation, and we're supposed to answer as to what specific internal control is missing in the fact situation they tell us about. So the first one says, while reviewing the records of Quality Pharmacy, you find that the same employee orders merchandise and approves invoices for payment. What is missing in that case of these control procedures?
Separation of duties?
Yeah, right. They don't have separation of duties. Okay, the same trusted employee has served as cashier for 12 years.
Job rotation.
Yes, that's job rotation. It might sound like a good thing, but it's not. Okay, grocery stores such as Convenience Market and Natural Foods purchase most merchandise from a few suppliers. At another grocery store, the manager decides to reduce paperwork. He eliminates the requirement that the receiving department prepare a receiving report listing the goods actually received from the supplier. What don't they have in that case?
Inventory control.
Kind of. What? This falls under other on the previous slide, but what we usually would say in this case they don't have is documentation. Okay, now we're going to look at internal controls that relate to certain types of transactions. And we'll start with cash receipts. And when we say cash receipts, we can actually be speaking about one of two things. We can be talking about actual currency, like you have in a retail store, or we can be talking about checks. Often when a customer pays with a check, we call that receiving cash as well. So first of all, we'll talk about a situation where you have a retail store. There, the internal control to a large degree involves the cash register, or if it's fully computerized, what we would call the point of sale terminal. And what we do in a retail environment is that at the end of a cashier's shift, they remove their cash drawer from the terminal, and they punch a key in the terminal to generate what's called a Z-tape, which is a summary report of all the transactions that have been run during their shift and what the balance should be in the cash drawer as a result of that at the end of their shift. And then they give that to a supervisor, and the supervisor counts the amount of cash that's left in the drawer and compares that to the Z-tape for how much cash should be left in the drawer. And then if there's a shortage, the supervisor notes that, and if the same cashier keeps having a shortage in numerous instances, then they would probably decide to terminate that cashier. Okay, then next let's talk about the situation where we're receiving payment from customers with checks that come in the mail. The first thing that might surprise you a little bit is that when the checks come into the mail room, the mail clerk should actually open up the envelopes that appear to have payments in them. And then the mail clerk divides the contents of those envelopes into two piles. One pile has the actual checks in it. The other pile has the remittance advices in it. And if you're not familiar with the term remittance advice, it's usually the bottom part of your invoice that you tear off and put it in the envelope with the check, and it tells how much you're paying on what invoice. Now, if a customer sends in their check without a remittance advice, then the mail clerk should fill out a form that looks kind of like a remittance advice that indicates who the customer was that paid it and what the amount was that they paid, and they put that in the pile with the remittance advices. Then the mail clerk sends the checks to the treasurer's department, since they have custody of the actual assets, and they send the remittance advices to the accounting department. In the treasurer's department, they prepare a deposit ticket, and then they take the deposit ticket and the checks to the bank. And then in the accounting department, they post the remittance advices to the customer's accounts, and they post the total amount to the cash account in the general ledger. Then the treasurer gives a copy of the stamped deposit ticket from the bank to the controller, and the controller compares that to the amount that the accounting department posted to the cash account in the general ledger to make sure that the two amounts are the same. To make sure, for example, that somebody didn't, swipe one of the checks that should have been taken to the bank, something like that. You want to make sure that the numbers for the treasurer's department and the accounting department are the same. Okay, next we'll talk about internal control procedures that relate to cash payments. Traditionally, most cash payments have been made by check, and a check itself is an internal control device. So a check provides a record of the payment. A check requires a signature by an authorized official, and there's supporting evidence that's reviewed prior to signing the check, which is something that we're going to talk about more in just a minute here. So let's say that our company is a merchandiser, and we're ordering some merchandise from an electronics manufacturer. What happens first is our purchasing department prepares a purchase order and sends it to the electronics manufacturer. Then the electronics manufacturer, based on that purchase order, ships the inventory to our company, and at the same time mails an invoice to our company. Then when the inventory arrives at our receiving department, a receiving clerk prepares a receiving report. And then after all documentation has been reviewed, which we'll talk about in just a minute, our accounting department prepares a check, and the treasurer's department signs the check and mails the check to the electronics manufacturer for the payment. Now, when we talk about documentation that is reviewed before a check is prepared and signed, the authors call this a payment packet. Where I worked, we called it a voucher packet, so there's more than one name for the same thing, but three of the documents that you will always find in this packet will include the receiving report from the receiving department, the invoice, and the purchase order. And usually a clerk in the accounts payable section of your accounting department will be responsible for reviewing these documents and making sure that they're all consistent with one another. And then where I worked, there was also a cover document that went over this that was like a pink sheet of paper. And once everything was in agreement and it was okay to cut the check, then the clerk would sign or initial the pink cover sheet to signal that a check should be cut to pay for this. So what the clerk would be looking for in reviewing the payment packet is that they would want to make sure that the quantity of the item was the same on the purchase order and on the invoice and on the receiving report. They would also want to make sure that the price that was quoted and put on the purchase order was the same as the price that was actually charged on the invoice. They would also want to make sure that on the receiving report, it said that all of the merchandise was received in good condition, that there wasn't any damaged merchandise that would have to be sent back, or that a purchase allowance would have to be negotiated for. So after everything appears to be consistent and appropriate, then they would sign off on this, and the accounting department would then prepare the check, or what we would call, they would cut the check. And then once the check is prepared, the check is taken by somebody in the accounting department to the treasurer's office. And it's the treasurer, with separation of duties, who will actually sign the check. And this payment packet is paper clipped to the check when it's taken to the treasurer. So then the treasurer will take a final look at the payment packet to satisfy himself or herself that everything is in order before actually signing the check. And then the treasurer's department will actually mail the check as well. So you definitely have separation of duties coming into play here between what happens in the controller's department or accounting department and the treasurer's department. Okay, a couple more questions here. A purchasing agent for Franklin Office Supplies receives the goods that he purchases and also approves payment for the goods. How could this purchasing agent cheat his company? Somebody have an idea about this?
He could say he didn't receive the goods,
And do what with them?
steal them and sell them, or try to get the money from the company and saying we didn't receive them, and try and get the company to reimburse or resend products to his company.
Yeah, that's pretty good. So they give two ideas here. The first one says approve payment for an excessive amount and split the excess with the supplier, or second, purchase the goods and have them delivered to his or her home. Okay, then how could Franklin avoid this internal control weakness? Well, I think it's pretty obvious. What they should do then is have separation of duties. So there are three separate functions here that should be separated. The purchasing of the goods, which usually should take place in a purchasing department. Receiving the goods, which should take place in a receiving department. And approving the payments for the goods, which should take place in the accounting department. Okay, next we'll talk about paying for things with actual currency. And this is what we typically call a petty cash fund. petty cash fund is used for small purchases where you want to make the payment for something immediately and not wait for a check to be processed. Where I work, checks were only processed twice a week, and you had to have your request in at least a couple days in advance. So if you needed just a few dollars for something, it often wasn't a very practical process to go about getting a check from the company. So they give some examples here of what petty cash could be used for. Office donuts, cleaning supplies, sympathy flowers, entertaining clients, not if it's a very large dollar amount, hopefully. Public transportation, tips for service providers. And a petty cash fund, by the way, it's usually like a small metal box with a lock on it, and you have a key, and someone in the company acts as the custodian of the petty cash fund. And because of separation of duties, the custodian is usually not anyone in either the accounting or the treasury department. Where I worked, it was the receptionist in the front lobby of the company who was the custodian of the petty cash fund. So we'll look at the journal entries that are involved here where you have a petty cash fund. And first of all, we're setting up the petty cash fund. So it says, on August 1st, Smart Touch Learning creates a petty cash fund of $200. The custodian cashes the $200 check and places the currency in the fund box. So the journal entry for this would be that we would debit petty cash $200, credit cash $200. The account that we call cash is usually that represents the company's general checking account. So when we credit cash, that means we're actually cashing a check at the bank. And something that you'll notice here with these journal entries is that the only time that we use the account called petty cash is if we're setting up the fund for the first time or we're increasing the size of the fund. If we're just replenishing the fund periodically, we don't use that account called petty cash. Now, every time that something is paid for through the petty cash fund, the custodian prepares a petty cash ticket. And these tickets are numbered sequentially, which is a type of control procedure. And it tells the date, the dollar amount of the expenditure, what it was for, what account should be debited for that, who it was who received the funds, and then it's initialed by the fund custodian. And then once these tickets are filled out, they're put in the box at the same time that the cash is taken out of the box. We call a petty cash fund an imprest system. And an imprest system is where you, as a matter of internal control, you maintain a constant balance in the account by, at any point in time, adding together the cash in the account, the cash in the box, let's say, plus the tickets in the box, and they will add up to a designated balance. In this case, our designated balance was the $200 that we started out with for the fund. So at any point in time, if we add together the amount of currency that's left in the box and the tickets that have been written up and placed in the box, the total that we should come up with is $200. That's what we mean really by an imprest system. Now, on August 31st, we're going to replenish the fund. And this is kind of an odd way of going about it, because usually you don't replenish it until you're almost out of cash. But here, they still have $118 of cash in the box, so I don't know why it is that they're replenishing it already. But they have $118 of cash. The tickets in the box add up to $80. So if you add together the cash on hand and the petty cash tickets, they should add up to $200, but they don't. They only add up to $198. Therefore, we know that we're missing $2 of cash. What we do in this case for our journal entry to replenish the fund is we use a special account called cash short and over. And if we're short cash, we debit the account called cash short and over for our $2 here. You'll recall that usually if we have an expense, we debit in our journal entry for an expense. So if we're short cash, that's kind of like having an expense. So it would be a debit to our account called cash short and over. If we had an overage of cash, that would be kind of like having additional revenue. So in that case, we would use this account called cash short and over, but we would credit it instead of debiting it. So here, when we replenish the petty cash fund, we debit each of the accounts that represent something that we use the cash for according to the petty cash tickets. So $60 was used for office supplies, $20 was used for delivery expense, and then we have a debit to cash short and over for $2, and then we have a credit to cash for $82 because we had to cash a check at the bank for $82 to bring the petty cash fund back up to its designated balance of $200. And notice, just like I said earlier, when we replenish the petty cash fund, we don't use the account called petty cash at all. Okay, here's a different example. And in this example, when it comes time to replenish the fund, they're actually over by $8. So in this case, here's what the journal entry will look like to replenish the fund. Here, we still use that account called cash short and over, but now it's going to be a credit entry to cash short and over for the $8. And the amount of cash that we'll have to get from the bank to replenish the fund will be $82. And that will bring our balance back up to the designated balance of $200. Okay, now if you decide to change the designated balance in the fund, then you will use that account again called petty cash. So here, in this example, it says on September 1st, Smart Touch Learning decides to increase the amount of the petty cash fund from $200 to $300. So in this case, we would debit petty cash $100, we would credit cash $100. And so what we're doing here is we're cashing a check at the bank for $100, and we're using that $100 to increase the designated size of our petty cash fund by $100, make it $300 now instead of $200. Okay, the next subject that we cover in this chapter is credit card sales. There are two methods that we can use when we're recording credit card sales. So a credit card sale, of course, is when we accept a credit card as payment when we're selling something to a customer. And when we accept a credit card for payment, the business has to pay a fee to the credit card processing company. In real life, the fee tends to be on average around 2.5% that the business pays for that. In this example, the fee is 4%. If this were an American Express card, then it might be 4%. American Express has higher fees than any of the other cards, so that's why some businesses do not accept American Express for credit cards. But the net method is used where every time there's a transaction, you take the fee out of it at the time that you journalize the transaction. So here, they're making a sale to a customer for $3,000 on August 15th. The customer pays with a third-party credit card. The card processor assesses a 4% fee, and they deposit the net amount of the sale into the business's account at the bank. So the journal entry that we would use to record this is that we would debit cash for $2,880, which is 96% of the $3,000 sale. That's why we call it the net method. And then we would have a debit to credit card expense or some similar name for 4%, which is $120. And we would have a credit to sales revenue for $3,000. Okay, the other method that can be used is the gross method. Here, we initially, when we have the sale, we record the sale for its gross amount. So on August 15th, when we make the sale, we debit cash for $3,000, we credit sales revenue for $3,000. Now, with this method, usually what happens is that at the end of the month, the credit card processor sends us a statement that tells us what all of our processing fees have been for the month. Sometimes the amount of the fees depends on what our volume of charges was for the month, and therefore they can't even tell us what it will be until they know what our total charges were for the month. But in this case, at the end of the month, they tell us that our fees are 4%, and so on August 31st, they draft our account to take 4% back out of it. So on August 31st, we would do a separate journal entry, and on that date, we would debit credit card expense $120, and we would credit cash $120. Okay, next subject we're going to talk about is bank accounts. And we already said that a check is a type of control device. There are a couple other types of controls, though, that also come into play when you use bank accounts. One is a signature card. A signature card shows us each authorized person's signature for the bank account. And deposit tickets, we talked about those earlier, but it shows the amount of each deposit that we make at the bank. These days, a lot of transactions are made using electronic funds transfer. And that's perfectly acceptable. It's less costly for a business to use EFT transactions instead of paper checks. They don't have the postage expense, it's faster. So with a lot of businesses these days, they have more EFT payments that they make than they do actual checks that they write out in mail. So there are certain types of internal controls that you can use with EFT payments in lieu of writing checks. So as long as you have some way of assuring that you have good internal control, it's fine to use EFTs type transactions instead of actually using checks. Why don't we take our 10-minute break, and then we have the last topic in the lecture to cover after that, which is bank reconciliation.